topic for today's lecture is money markets. And money markets we understood is one of the component of these financial markets. Money markets are those places where banks or individuals actually meet their very short term monetary requirements. Usually banks are the only players in these money markets. There's no play for individuals in these markets. Now let us look at the definitions of money markets. Geoffrey Crowther, in his book An Outline of Money, has stated money market is a collective name given to the various firms and institutions that deal with the various grades of near money. Similarly, J.M. Culbertson, in his book Money and Banking, has defined the money market as a network of markets that are grouped because they deal in financial instruments that have a similar function in the economy and substitute from the point of view of holders. Money market instruments are liquid assets that mature quickly or are callable on demand. Now let us look at the types of money markets. Money market, as we understood, is a place of trading in the money or near money securities which can be traded or converted into cash at a very short notice and also with less loss of time. Now what could be these securities which qualify as near money instruments? These could be our equity shares or mutual fund SIP investments, the units of mutual funds, which can be put on sale and immediately can be realized into cash with a trading cycle of T plus 2 days. Or these days actually it's happening even T plus 1. Today you put a transaction for sale of a security or a mutual fund, number of mutual fund units, and by tomorrow the amount gets credited to your bank account directly. So it also saves you the hassle of even going and visiting a bank, filling up a money, a cash or a check, asking them to pay you the money. So it's simply at a click of a button that you can encash your investments also in the markets. So one of such markets is the money markets that is available for us. It provides an opportunity for balancing the short-term surplus funds of the lenders or investors with the short-term requirements of the borrowers. Now again, the money markets are categorized into two types. One is the unorganized money markets, which includes all the money lenders, the chit funds which are not in the regulated space, and the organized money markets, which we are very familiar with, which includes the banks and the financial institutions. So now let us look at what is this unorganized money markets and what is the need for existence of these unorganized money markets. Now their activities are not regulated like the organized money market. Now what is the reason for such unregulated markets still existing in India? As we understand, India is a huge country with lot of rural population. All of them are having cell phones, but their financial literacy is not that good. So they are easily influenced by people who have money, and if they have some monetary requirement, they are being charged a very high rate of interest because they are able to meet their immediate requirements with the money that is available with them. Now these people come in the form of lenders or pawn brokers who actually put one of the smaller assets of these individuals with them, and then they lend the money, and they also charge a huge rate of interest on this money. Now these people are not registered with any regulatory body, and hence they don't come under the purview of any of these the legislations or the rules or the compliance aspects of the regulatory bodies. Now what are the reasons for the presence of the unorganized money market sector? As I said, one is the financial illiteracy. People are not aware of the benefits that they have if they are registered, if they have an Aadhaar card, if they have a bank account, then what are all the schemes under which they are eligible to apply for their monetary requirements. It could be a requirement of a small time vendor, a roadside vendor who wants to expand his small little business and he wants to put it into a small shawl. But then for that he needs money, and then if he needs money, he looks at going to a bank as a big hassle. He feels that if he goes to a bank, they will ask him to first deposit a huge sum of money, and after a lot of applications and lot of processing there, he may not actually get the money that he requires, and in the process he will lose his time, which is actually money for him. Time is business for them because they are always on the job, and also a loss of money for them. So one is lack of penetration and presence of instruments of organized money market for these small time investors or small time vendors, because of lack of certain documentations, they are not available to access money from the organized sector, that is the banks and the financial institutions. Then there are many needful customers in the money market who are not coming into the purview of these financial institutions. As I said, one of the reasons could be lack of having a bank account in their name. Now, if I have to give you an example, there is something called as conditional maternal benefit scheme, which is offered by the Government of India, Ministry of Women and Child Development. So, as per that scheme, pregnant and lactating women are eligible to get a conditional cash benefit. That means they are eligible to get paid some money to take care of their health during the pregnancy and the lactation period, which money it has to be credited to their bank account. Now imagine how many women in the rural sector will be having a savings bank account in their name. Most of the time, the Anganwadi workers have to go and convince these women to even open a bank account in their name, because they are not ready to do that. Instead, they would want to open the account in the name of their husband or father or brother, because they feel that is more safer, as they do not know anything about the financial transactions with these institutions. But then the scheme does not allow credit of money to any of these family members. It only allows credit of money to the beneficiary, that is the pregnant and lactating women in this particular example that I gave you. So such people are not falling under the purview of the regulated money market segment. And then because of lack of awareness also, people get cheated in this unregulated markets, and these are also spreading in the rural areas, more so in the rural areas, because of ease of access also. The moment somebody wants money, the lender is ready to give the money at the drop of a hat. But then when he is collecting back the money, he is equally rude and ensures that he gets a huge sum of money as interest paid by these people, which may be actually amounting to more than the principal amount that they borrowed. The principal plus the interest that is being recovered by these lenders is sometimes much more than the principal that was borrowed by the borrowers in the first place. So that is how these unorganized money markets are thriving in our country, more so in our country, because of all these restrictions. The unregulated non-banking financial intermediaries, as I was mentioning, which are also mentioned as chit fund companies. A chit fund is opened by anybody, a random neighbor or a colleague in your office also could be operating a chit fund, where they say a monthly collection of X amount is done from 10 different people with an assured sum after 12 months or a 20-month period, and then whoever wants the money in each month they do a draw and they issue the money to them, and post that they also have to pay an additional amount instead of the actual amount that was decided as an installment. But the advantage that they have is there is no banking hassle, there is no documentation that is required. It's simply a transfer of money. Either these people give the money in cash, or they may be doing, in case they have access to apps, they may be doing something like a Google Pay or a UPI app or something on these lines. But then they don't have to go to a bank, they don't have to really fill a form to get the money that they need, and they are getting it at their doorstep or in their bank account directly. So that is one way they operate. So these chit fund companies, or chit funds rather, and the nidhis, which are mostly operated in the South India, where the money is lent only to the members of that particular group or the committee which is formed as a nidhi. The rate of interest that they charge is very high, extremely high, to the tune of, let's say, 36 to 48%, and hence they are very exploitative in nature, and they have a very selective reach in the economy. Similarly, the money lenders constitute the most localized form of unorganized money market sector. They are also very exploitative when it comes to their interest collection. Then let's move on to the organized money markets. So unorganized markets are prevalent and which have to be curbed, but sometimes they also come in handy for the general public and small time business people who need the money at a short notice. Now when we look at the organized money markets, several categories in that. We have a call money market, we have a bill market which includes both treasury bill market and commercial bill market, and we also have a bank loan market, that's a short term loan market. The organized money markets, which are again subdivided into call money markets, the commercial bills market, treasury bill market, and short term loan market. Now, under the call money market, what is the purpose of having a call money market? Now, banks, banking transactions are happening every minute. Even when we are speaking and listening to each other, there are hundreds of people who are paying money and hundreds of firms who are earning money. So, it's an exchange of money happening continuously over the electronic media or electronic ETF, electronic fund transfer mechanism, and also in the form of a cash. Now, in the process, at the end of the day, when the banks are settling the account, that means what was the receipts for a particular day, what have been the payments in a particular day, they arrive at a figure which is either excess, that means they have surplus money, or which is at a deficit, they have a crunch in their availability of funds. Now, money market is one place where the banks can fill the gaps of the temporary mismatch of funds that arise because of the daily transactions. Then it is also a way for them to, an avenue for them to meet their cash reserve ratio and statutory liquidity ratio, which is a mandatory requirement stipulated by the central bank, that is the RBI in our case. Then one more need for the existence of money market is to meet any sudden demand for funds that may arise from large payments, a large, let's say, advance tax payments, or some loan repayments, or somebody has taken an excess loan from the bank. So, when such large payments happen also, there could be a short fund crunch in the banks or financial institutions, for which they fall back on the money markets because it's a very temporary phase. This excess funds or shortage of funds happens on a daily basis, and even in that case the banks have to match up because they'll have to maintain their CRR and SLR as stipulated by RBI. Now, call money market creates an equilibrium for the short term liquidity requirements of banks. As I said, if they have excess funds, even for a single day, that excess fund can be lent to another bank which has deficit of funds. So, they are earning money for a single day. Even for few hours, there could be a lending and borrowing transaction that happens in a call money market. So, it's an integral part of the Indian money market where day-to-day surplus funds are traded by banks. It's usually lent for a very short term duration. The duration is from 1 to 14 days or 1 to 15 days. So, for each of these durations, the terminology also differs. It is called as call money if the money is lent, the surplus money is lent to a bank which has deficit of funds for a single day. For one day, if the money is lent, it is termed as call money. Now, if the money is lent for more than a day but less than 15 days period, then it is termed as notice money. Parties which are involved in these transactions are only banks and financial institutions. No individuals have a role to play in this particular money market transaction. The call money market transactions are all to do with only the banks having surplus funds and deficit funds. So, call money is a money which is lent for only a single day, and notice money is a money which is lent for more than one day but less than 15 days. Now, when money is lent for more than 15-day period, then it is termed as term money. It could be for 3 months or 6 months or 9 months, but a period of less than 1 year. So, that is actually coming back to the money markets again. So, borrowing is exclusively limited to banks that are temporarily short of funds and temporarily have excess funds with them. Call loans are generally made on a clean basis. That means there is no collateral that is required. Collateral is, when an asset has to be put, mortgaged with a bank to take a loan from the bank. But in the call money market, there is no need for a collateral because it's a transaction between two financial organizations or banks themselves. The main function of the call money market is to redistribute the surplus funds which are available with few banks to the banks which are having deficit of funds on a day-to-day basis. So, that's where we looked at call money, notice money or term money. The call money helps banks economize their cash and yet improve their liquidity. Now, what is liquidity? Liquidity is the availability of cash at the disposal of the bank. So, if it is not having enough liquid funds, whenever there is a major payment that is demanded, suddenly the bank becomes cashless. So, that's a very bad situation for the bank to be in. So, they always try to have a safety reserve with them, and in case they are falling short of that safety reserve, that's when they take a loan from the call money market, wherein they can take this loan for a period of one day, 2 days or whatever number of days they require when they feel that there could be a deficit of funds which they'll have to balance. Now this market is again a very highly competitive market and also very sensitive market, because it's all to do with the dealings of one bank to another bank, and each bank might have a different number of accounts or transactions that they have, and hence the balances alter every day. It's not that every day one bank will have excess of funds. One day it could have excess of funds, another day it could have deficit of funds. So one day bank A could be a lender of money, on the second day it could be the borrower of the money. So the bank's role differs on a day to day basis based on the financial availability that it has of cash. It also acts as a good indicator of liquidity position. Now let us look at what have been the developments in money market. Now it is not very safe that banks do this day to day transaction and understand when they have to borrow money and when they have excess money to lend. So prior to mid 1980s, participants depended heavily on the call money market. For any of these cash crunch or excess cash available with them, they would readily go to the cash money market and invest the excess money or borrow money if they are falling short of money. The volatile nature of the call money market actually led to introduction of the treasury bills. Now treasury bills are more safe when you compare to these call money markets, and they are also standardized because they are issued by the government bodies or the government of India itself through the RBI, that is the Reserve Bank of India. Now emergence of market repo and also collateralized borrowing and lending obligations have also happened because of the weaning away of the financial markets from call money markets to more stabilized instruments. In this case, the treasury bills, the market repos and also the CBLOs. Now what is a treasury bill? Now treasury bills are short term liabilities which are issued by the government of India. Now these treasury bills are also referred to as T-bills, and the market is referred to as T-bill market. Treasury bills are issued for a duration of either 91 days or 182 days or 364 days by the government of India. It is a promissory note where the government is saying that I owe you, or OU is OWE, they owe money to us, and a promise to pay the stated amount after expiry after the defined period from the date of issue. So if they are issuing a treasury bill on day 1, they write a promissory note wherein it is mentioned that government of India owes X amount of money to this particular investor and is repayable, this money is payable to him on the 91st day of the treasury bill or 182nd day or 364th day, because that is the duration for which the treasury bills are issued. Now these bills are issued at a discount to the face value. That means if the bill has a face value of, let's assume, 1000 rupees, it may be issued at a discount of let's say 20% or 30%. If it's a heavily discounted bill, it could also be issued at a 50% discount. That means on issue, when an investor is buying the treasury bill, he must have bought it at a price of 500 rupees, a treasury bill of 1000 face value. But at the expiry of the treasury bill, the full amount of 1000 rupees, that is a face value. So the difference is the earning that the investor has. The rate of discount and corresponding issue price are determined at each of the auctions. Now these treasury bills are auctioned, and then investors can go and buy these bills at such auctions. RBI auctions the 91-day treasury bill on a weekly basis. Every week they auction the 91-day treasury bill, whereas every 15 days they auction the 182-day or the 364-day treasury bills. So these are the timelines which are defined by RBI as to when they will auction the treasury bills, which are the duration is different. As I said, they are issued for 91 days or 182 days or 364 days. Now as the time passed, there are several money market instruments that have been invented and are being used now productively in the financial markets. So few such instruments are certificates of deposit, commercial paper, interbank participation certificates, interbank term money, treasury bills, bill rediscounting, call money, notice money, term money, the collateralized borrowing and lending options, and also the market repo. So let us look at each one of them and understand what are all these instruments that are available and how are they being used by the market in general. Certificates of deposit. Now these are short term borrowings in the form of UPN issued by all the scheduled banks and are freely transferable by endorsement and delivery. So it's a certificate of deposit. So once somebody makes a deposit in the bank, they are issued a certificate of deposit and they are for a specific purpose. And these are very short term borrowings and they are also freely transferable by endorsement and delivery. Now these CDs, as they are called as, were introduced in the year 1989 and they are issued with a maturity period of not less than 7 days and a maximum time period that they can be issued is for a year's time. Now financial institutions are allowed to issue the certificates of deposits for a period between 1 year and up to 3 years. Now subject to payment of stamp duty under the Indian Stamp Act 1899. So these certificates of deposits are subject to payment of stamp duty. These are issued to individuals, they are issued to corporations, they are issued to trusts, funds and also associations. They are issued at a discount rate freely determined by the market or the investors. So this is one of the investment options which is available for individuals, corporates and also the government bodies or associations when they want to invest into short term funds. So these are issued as short term borrowing papers whenever people are buying such deposit papers. Now coming to commercial papers, these are short term borrowings by corporates, financial institutions, primary dealers from the money market. Now these can be issued in the physical form, that is the usance promissory note, or in the demat form. Certificate of deposits were only being issued in the usance promissory note form, but commercial papers are also issued in the demat. Commercial papers have been introduced in the year 1990. When issued in physical form, these are negotiable by endorsement and delivery and hence they are highly flexible. They are issued subject to a minimum of 5 lakhs and in multiples of 5 lakhs thereafter. That means each commercial paper's value will be a minimum of 5 lakhs or it could be in multiples of 5 lakhs. That means 10 lakhs, 15 lakhs, 25 lakhs and so on. Now what is the maturity period of these commercial papers? Here also the maturity is from 7 days to 1 year. So it could be as short an instrument as issued for only 7 days to an instrument which can be issued for a period of 1 year. And these are not secured, so they are unsecured and backed by the credit rating of the issuing companies. Now the issuing companies are assigned credit rating. Now not just the company, even the instrument, that means the commercial paper also will be credit rated by the credit rating agencies. So we have several credit rating agencies which are again authorized players and approved by SEBI. Now these rating agencies, they actually look at the instrument which is being offered. So in this case it's a commercial paper. They look at the features of the commercial paper, at what rate is it priced, what is the maturity period, what is the yield to maturity of this particular instrument and which company is issuing these commercial papers and what has been the financial performance of the particular company which is issuing the commercial papers. So based on all these aspects, the credit rating agency will assign a particular rate to the commercial paper. So based on the rating which is given by these credit rating agencies, the commercial papers marketability varies in the market. That means if there is a bond or a commercial paper with a AAA rating, then people will assume that this is the highest or safest investment avenue that they have. That means there is no risk involved if they buy these commercial papers. So based on the riskiness, if the rating agency has given it a rating of, let's say, B minus, triple B minus, that means there are certain concerns about the safety of the principal amount and the investor would actually think twice before he invests his money into such commercial papers or such market instruments. So the rating of these credit rating agencies also plays a vital role when such papers are being put up for issue in the market by the issuing company. And these papers also are usually issued at a discount rate. That means, as I said, if the face value of the commercial paper is assuming it's a 1000 rupees per paper, then they could issue it at a discount and redeem it at premium. Now, issuing a discount means they are collecting less money, less than 1000 rupees. So, face value is 1000. So, the rate of discount also can be decided by the issuing company. Some companies would want to discount it at 20% rate. So, in that case, the purchase price for the buyer will be only 800 rupees. But after the maturity period, the company will redeem it at par or at premium. So, what is redemption at par? Redemption at par is paying the actual face value of the instrument to the purchaser, that means to the investor. And redemption at premium is, again there is a percentage defined for premium also. Let us say if the company advertises issue of commercial papers issued at 10% discount and redeemed at 5% premium. That means the commercial paper, when it gets issued, it will be issued at a discount of 10% from its face value. That means assuming the example that we took, 1000 rupees is the face value of one commercial paper. So, 10% discount, it will be sold at an amount of 900 rupees to the investor. And then based on the tagline about the advertised commercial paper, if they said that it will be redeemed at a premium of 5%, that means when they are paying back the investor, the amount that they pay back is not just 1000 rupees, it will be 1000 plus 5% of 1000, that means 1050 is what the investor gets paid. So, he has a two-way advantage. He bought it cheap and then he is selling it at a dear price, at a costly price. So, that is how the investors benefit when they are buying or selling these commercial papers. Then we have market repos. Now, what is this repo? Repo is nothing but a repurchase agreement. So, these are the instruments which enable collateralized short-term borrowing through the selling of debt instruments. A security is sold with an agreement to repurchase it at a predetermined date and rate. That means there is again a promise here. So, they are selling a security to the investor and they are also mentioning on what date it will be purchased back from the investor and at what price it will be purchased back from the investor. So, it could be a bond or a debenture, which again, as I gave an example previously, like similar to a commercial paper, and the instrument could also be redeemed either at par or at a discount or at a premium. So, based on the necessity of funds of the issuing organization, they will decide the terms of issue at discount and redemption at par or premium. So, a 100 rupee face value bond, if they are issuing it at a discount of let us say 5% and redeeming it at par, that means a debenture which has a face value of 100 rupees, an investor is able to buy it at 95 rupees only because it is being issued at a discount of 5%. But it will be redeemed at par, that means redemption is nothing but repayment of the principal amount. So, at par is at face value. So, when the company is taking back that instrument from the investor, it will pay him full 100 rupees, although it sold the instrument to the investor at 95 rupees. So, that is the benefit that the investor is getting. Similarly, if the issue is happening at a discount and redemption is happening at a premium, here it is a more advantage for the investor because he is paying less price for the instrument and he is being paid more when he is returning back the instrument to the issuing organization. So, the same example of 100 rupee debenture, if it is issued at a discount of 5% and redeemed at a premium of let us say 5% again. So, for the investor the purchase price is 95 rupees and the redemption price, that means when he is getting paid back the principal amount by the issuing organization, he will get paid 105 instead of just 100 rupees, which is the face value of the debenture. Similarly, in some cases it could also be the other way around. They could issue an instrument at a premium and redeem it at a discount also. It depends on the financial requirements and the financial credit rating of the company. So, if they are issuing it at a premium, a 100 rupee face value debenture could cost more to the investor. Let us say they are issuing at 10% premium. So, he will have to pay 110 rupees for a debenture whose face value is only 100 rupees. And then they may redeem it at discount also, discount of let us say 5%. In that case, when at the time of maturity of the instrument, the investor gets paid only 95 rupees instead of at least 100 rupees. So, these are the different ways in which the commercial instruments are issued and redeemed by the issuing organizations of firms when they want to access markets and raise money.